All right, hi there. I'm Julian Jackson. I'm the author of Home Loans Approved the Right Way. And I just wanted to kind of go over a few tips on what you can do to get mortgage ready credit. So, a lot of times I think people get started in the home buying process and they think that they can't qualify because there's so many different things you have to think about to get started. And part of our goal is to make sure you can get there, even if you're not in the best shape as far as your credit's concerned. We have seen as much as 130 points in under 6 months using this program. So basically, we want you to have a head start. Start thinking about this early. Don't wait till the last minute and then try to see if you can fix things. But the key to getting mortgage ready is to work with a loan officer, and then obviously have a good realtor that's able to help vet some of those loan officers for you and make sure that they're doing the best job for you and have the kind of programs needed to help you out. One of the best things you can do with a loan officer is kind of avoid credit repair if it's not really needed. There are going to be cases where credit repair is needed, but that's not always the case. So what you want to do is make sure you work with a loan officer first, and they can kind of give you the guidance you need, because getting mortgage ready credit is different from credit repair. When you're trying to get ready to get your in a better place for mortgages, it's not always in your best interest to pay every single debt completely off. Matter of fact, in some cases, it could hurt you. So before you get started, you want to have a game plan, and that's what we put together for you here. Again, it's getting mortgage ready, and I guess more accurately, be getting mortgage ready credit for the best rates and programs while shopping for a home. This advice comes from the book that I wrote back in 2009. At the time when the mortgage industry was kind of going crazy and people were getting burned left and right. And so I put together a book because, as a loan officer and an instructor for the state of Texas, I actually got burned by doing a power of attorney in Georgia, having a home closed, and someone did exactly to me what we were teaching people was predatory and fraudulent. And so I wrote the book because I wanted people to see, like, this is the right way to do a mortgage. These are the things that lenders and loan officers should be willing to do for you, not just try to find, someone with perfect credit and great debt to income ratios and never have to do anything to help you. Because back then, that was the thing. If you were breathing, they could get you into a loan. So they didn't have to do much work, and everyone was getting a home. And then we went into foreclosure on a regular basis. So a lot of people think, well, that's not really cool, because here we are getting homes and then we're getting booted out of them. But at the same time, everyone wants a home. So why not go ahead and take a risk, and maybe we can get lucky and keep this place? Well, most people couldn't, because there were so many different things that were happening, like arms, which are not really a big deal. It's just that you need to understand what's happening when you get an adjustable rate mortgage, an ARM. Um, but before you even get to that stage, you want to think, what does my credit need to look like? What does my debt to income ratio need to look like? And that's the piece that we're going to show you here. So if you'd like to enhance your mortgage credit scores, please complete this free 1-day mini course that we're going to offer you here. It's just take 20-30 minutes to watch this video, look at all the things I described, and then what we're going to do is we're basically going to put you on a campaign that's going to come out every week, and it's going to ask you a series of questions, and all you got to do is answer those questions so we'll know how better to help you. Some of the things you'll be able to get done right away. Sometimes it's going to take maybe 30 days before you can have your credit pulled again, but we're going to ask you to monitor your credit through Credit Karma, some of these other things. But I'm going to walk you through so you can see exactly how this plan helps you. And like I said before, as many as 130 points in under 6 months if you follow the plan. Just a disclaimer for you: this is not a credit repair course, because we're not trying to repair your credit. That's a totally different scenario. In some cases, you're going to need help getting your credit lines deleted. I'm going to even show you how to do that on your own, but sometimes it's just easier to have someone else do that for you, and that's where credit repair can come in. But I would not take that step unless you have a mortgage professional tell you to do so. They will pull your credit, look at it, and tell you, like, all right, there's certain situations where we don't want you paying off these bills, because it may restart the clock. And if the last 12 to 24 months really matter the most, and those are outside that window, and you start them, it could create a problem. So make sure you work with a credit professional, a mortgage professional, and let them guide you into a credit professional's hands before you start making these or taking these steps. All right, we're going to jump into a lot of these different things, starting from your credit report and credit scores. What's on it, what difference does it make, how they score, so you can understand, and some of the negative things that impact your score, why you need to dispute it. Everything from 12 months all the way to the month the day that you put the keys in your hand. We're going to walk you through all of that stuff right here, and then at the end we're going to talk about sample dispute letters. So diving right in, your credit report and your credit scores, right? Well, a lot of people don't realize you don't really need much more than a 640, 650 credit score to get into a home. Now you might hear over 700, but that's to get the best rates, terms, and insurance rates and everything else. And I'll explain exactly what that means. But a lot of the reason why some people's scores are lower than what they can imagine, or they may not even know, is that the Public Interest Research Group did this study back in 2004. It showed almost 80% of credit reports have at least one mistake. That one mistake could cost you 20, 30 points on your credit score or more. Some credit, 54% had wrong information. Well, why is that a big deal? Well, let's say that there's a junior and a senior. Well, if that junior has information on from the senior's credit, it could bring the scores down, even if that junior has nothing bad or derogatory going on in their actual life. So you have to check those things, to double check, triple check, and make sure those things aren't part of the scenario. Now, how does it impact your score? Okay, first off, payment history about 35%. I can tell you right off the bat, 12 months, you need to have a clean payment history. If you have any late payments, 30 days, 60 days, 90 days, or anything longer, you don't even want one 30-day late. Not even one. It's going to hurt your score the most. And the thing that's really tough about it is, let's say that you find out that you have been having a history of 1 month late payments. Doesn't seem like a big deal. You're only 1 month late, but it's been over and over and over again. Let's say the last payment that was late was last month. You got to wait 12 months and have a great payment history from that point forward for most of your lenders to even be able to help you a little bit. So you're thinking, well, I don't understand how this matters so much. I'm only late because I wait to the last minute to pay that bill because I'm trying to pay other stuff before I get to this one. Well, that's the kind of thinking that gets people in trouble when it comes to credit. So your lenders out there are thinking, well, we can't have someone who's going to wait to the last minute to pay their mortgage because it goes into foreclosure. We're in trouble. We can't have people having late payments because it just starts to snowball. Then there's the amounts owed. 30% of your score is based on the amount of credit or the amount owed on your credit. So if you think about it, it takes in consideration how many loans you have and the balance that you have. So let's just start with credit card. I'm going to go with the toxic debt, and I'll explain what that means a little bit later. But the toxic debt could be a credit card. Let's say you have a $1,000 limit on a credit card. Well, how much do you owe on that credit card? If you owe $500 on a $1,000 limit, that's 50%. Here's the interesting part about that. If you had $500 on a $1,000 credit card and you were to pay just $1, it's going to bring it under 50%. That has the biggest impact on your score. We've seen where people would have, let's say, $1,000 balance and a $550 was the balance on it, and you paid $59 or $51 to get just under the 50 percentile. Your score may go up 30 points. By the same token, if you're under 50% and you put over 50% on that card, it's going to go up by 30 to 50 points, depending on where your credit is, what scores you are currently. So the best way to raise your scores is to make sure every single, especially revolving, meaning credit cards or things that you can use over and over again, those type of cards, you want to make sure you keep them under 50% at all times. Don't try to get it up to the max and then pay it off. Even if it's a $300 card, a $100 card, you don't want to ever go over 50%. Now, if you were taught anything about credit, a lot of times, like you have a lot of these coaches out there like Dave Ramsey, who I hear is decent at what he does, but I'm going to disagree with him on certain things. Like if you don't, how are you going to have an emergency fund if you don't have the money to put away? But if someone offers you a credit card and it's $1,000 limit, that could be your emergency fund. If you never use that card, you're going to have really good credit for one. But number two, if an emergency comes, you're not having to dip into your savings. So it's going to help you get your credit scores up. And without credit, you're not going to be able to buy a house. So if you're never getting credit, which some people advise, then that's going to put you in a bad place because now you're in trouble. What if your credit card was a $2,500 limit, you never used it, and then a car blew out on your tire blew out on your car? Guess what? You can take that card and pay that off without having to dip into your savings and keep yourself from eating or missing meals or whatever fuel in the tank because of the card. Now, of course, it may charge you, whatever it charges to get a card done, and then you got $30 a month to pay it off until you catch up. Well, that little piece is still not going to be over 50%. As long as you keep it under 50%, it's not going to hurt your score as much, but it is going to hurt the score. Length of credit, how long have you had it? So I've seen where if you go 240 months, 20 years, that you will see the biggest increase for length of credit. A lot of people think if they close down their credit accounts when they finally get tired of using them, they're like, it's just becoming a distraction because I might use it and I don't want to use it. Well, maybe cut the card up, but don't close it. Because if you close that account and it has the longest history, you're going to hurt yourself as far as points are concerned. It's like the first 10 years, you may get 3 to 5 point increase. 10, 15 years, you may get another 5, 10 point increase. But when it hits the 20-year, 240 month mark, that's when you're going to see like 30 points added to your score just from how long you've had the credit history. Most of the people that I've seen that have over 800 credit scores, pretty much every single one of them has a credit card with absolutely no, late payments or anything for at least 20 years. Um, New credit. So that's where the inquiries come in, right? So if you start looking for any type of new line of credit, it's going to hit you. Usually it's minimal. It's not going to be as much as some of the others. Who knows, anywhere from 3 to 10 points possibly. But the trick here is when you're working with a mortgage and you get your credit pulled by a lender, you have 30 days from the time you get the first one pulled to shop for other lenders and see which one can probably possibly get you the best deal. Or let's say you got to work with new bills and they want to pull to give you incentives. You just want to be careful not to exceed that window. So typically when you start shopping for lenders, spend about 2 to 3 weeks trying to find the ones that can help you the most with your scenario. Again, if you get your credit to a 650 or better, there's different programs out there that you can probably qualify for without having to go these extra steps. And then there's types of credit use, right? So if you have revolving accounts, retail accounts like credit cards, like I said, or department store cards, that mix versus installment loans versus mortgages, the more different types of credit you have, the more it's going to help you. So if they've seen that you had a mortgage for 20 years, a 30-year mortgage, and you paid it off in 10, or you sold it and you were good on your payment history, obviously that's going to look better than not having that. It's not going to hurt you, but it's not going to help you as much. And that's how you get your scores up. That's how you break down the scores. Now, what does all this mean, right? You can have credit scores, but you want to know exactly what they're doing for you and what's good, what's bad, what's fair. Well, like I said, you may hear 700 plus is a good score. And I'll show you why that matters, but it's not necessarily something you're going to need to get approved for the best rates in mortgage. The insurance rates are going to be affected, but the mortgage is what makes the difference when it comes to your principal, interest, taxes, and insurance. So 650 is pretty good. It'll get you qualified for most products. Now, you may need a 680 for what they call conventional, but we'll get into that in a little bit. 620 to 650, pretty much these are the scores are very good when it comes to mortgages, because if you have a 620, you can qualify for down payment assistance programs. Now, there's another zero down program called USDA, and I'll show you that a little bit later. But you need 640 for a lot of the builders to work with that number, and a lot of other lenders out there need a 640. Some go 660, but typically it's 640 for you to be able to use that. And then 620 or below, yeah, you're going to pay a higher interest rate. And so a lot of times people wonder, like, well, what difference does the scores make? Well, if you have 700 credit scores, you are going to pay a lower interest rate than people who have lower scores. And what does that mean? Well, the higher interest rates you have, the less amount of house you can afford for the same monthly payment. So let's say you want to keep your monthly payments around $1,500, $2,000 a month. Well, if it's a $2,000 a month with someone with a 700 plus credit score, maybe that $2,000 will afford them $300,000 worth of home. If your scores are not in the 700s, they're in the 620s. Maybe you go in some places like FHA, you can go down as low as a 580. So say you have a 590, you qualify, but your interest rate is going to be higher. What does that mean? That same $2,000 isn't going to be able to afford you a $300,000 home. It may be 280, 275. And these are just examples, but you can afford $20,000, $25,000 less because your scores aren't as high, and the interest rate is going to take away from your buying power. So you want to have low interest rates, and the way to do that is by keeping your scores higher, especially 650 plus. That's typically where you're going to be able to do pretty decent no matter what company you work with. 680, even better. 700 plus, the best interest rates out there. And it matters. Now, the one thing I did want to convey to everyone is when it comes to debt to income ratios and credit, they kind of work together. What you notice is the higher the scores, usually the lower the debt, because debt is what eats up the score. So if you keep your debts low, your scores are usually high, unless something, drastic happened. Or like we talked about in the previous page, you have late payment. If you have a late payment that's a month old, you could have great credit and that thing's going to take 30 to 50 points away, and boom, you're at a 720. Now you're at a 670. It's going to affect the interest rate because of that one payment. Now, yes, they will take that in consideration, but it's going to hurt you in the beginning, and it's going to take time for that to go away. As an example, like I said, 720 credit scores, interest rates are starting to creep up in the fives, right? Well, imagine a 720 credit score, and you got a 5% interest rate. Or if you had a 556, back when they used to do this, they don't really qualify you at 550s anymore. But back a few years back, this is what you'd see. Major difference in payment, right? So if you're looking at what, $160 a month difference because your interest rates are that much different. So that can definitely affect you. And that's, principal, interest, payments, not taxes and insurance. Taxes and insurance are going to change that payment for you. And taxes obviously aren't going to be affected by your credit score. That depends on where you live. But that's it. Principal, interest, taxes, and insurance. Now, does it affect your insurance? It does. So taxes, can't really do much about that. Principal, typically the same, but the interest payment is going to be higher because interest is higher, you're going to pay higher. And then now you got to add the taxes and insurance. So that payment for a $100,000 home could be $1,000 for some, could be $1,200 for others. And the reason being is because when they add the homeowners, or when they add insurance scores, when you get that hazard insurance for your home, you get a 30% discount with a 739. So I tell people shoot for 740, 750 because that gives you the biggest discount on insurance, which will also lower your monthly payment. If you keep it under 620, then look at this discount. 580s and below, or 586 and below, 0%. So you don't get any type of discount when your scores are in the fives or under 586. Now, just barely 4%, but why not go for the 30 if you can? Typically, when you get approved for a mortgage, you're going to be in this range or this range. So at least 12 to 20% you can expect, typically, for most people that have a 620 credit score, better to get a discount on their insurance. And that's going to help because that keeps the insurance payment down, which keeps your monthly payment down, which is added into your debt to income ratio. If you're not sure what debt to income ratio is, it's basically your debts divided by your income. So add all your debts together, everything from revolving cards to installment loans for like a car, and any other type of loans that you have that you pay on a monthly basis that typically show up on your credit report. Those monthly debts that show up on your credit report, add them all together, divide it by your gross monthly income, and that's how you determine your debt to income ratio. So let's say you have $6,000 a month is what you make, and you add up all your debts together and they come out to $1,500. So you take $1,500 divided by 6,000, and I'm going to say that's 25% debt to income ratio. Not too bad. Now they also add your house payment, potential house payment, into that. So let's say you go, it's another $1,500. So it's $1,500 that you pay every month plus $1,500 that you pay for your mortgage. That's $3,000. 3,000 into 6,000 is 50%. So now your debt to income ratio is 50%. Most of your FHA programs will let you go up to 54.99. There's some that are a little higher, but we don't want to take that chance. The other thing you'll look at, and I'll go over this again as well when we talk about FHA, USDA, different types of loans, there's the debt to income ratio is 50% is pretty much as high as you want to go with anything and everything when you add all your debts together, including your house payment. Now, looking at your personal information, your public records, collections can really hurt you. Your personal information, public records, that can hurt you. Inquiries can hurt you, but this stuff isn't really added into your score. There's nothing about that that's going to be affected. But let's say you have tax liens, bankruptcies, child support issues. Not only will you see these in the credit report, and they can have a certain amount of effect if someone has charged you, and kept up with these particular things. It's going to show up in your credit, but it's also going to affect you in a system that lenders use to keep you from getting approved. Now, there's also collection items. There's account information. There's inquiries. We talked about how those affect your credit. And so now you have a pretty good understanding of what your credit looks like. So that's basically where I'll stop on this first section, because I want you to be able to understand your credit and basically how that works. And then we'll catch you on the next video.